Hello, everyone. My name is Shalon Williams. I'm the Director of Investment Management Services at NEI Investments. Today, I'll discuss NEI's tactical investment strategy in our Managed Asset Allocation Pool, or MAAP for short. Given the level of market volatility and the pockets of opportunities that arise in this type of environment, the team has been very active in managing our MAAP portfolio. The pool is a tactical investment strategy that provides opportunistic exposures through a mix of ETFs, which are diversified across fixed income, equities, and geographic markets as well. MAAP allows us to take advantage of shorter term opportunities in the market by shifting the pool's asset allocation with minimum disruption to the core investment strategy. The team at NEI assesses market conditions through macroeconomic indicators, through sentiments, as well as fundamental valuation angles, then adjusts asset allocation accordingly to safeguard assets or to capitalize on market opportunities. So let's talk about some of the trades that we have done recently. We have made a number of trades in the portfolio since our last update. So we closed the month of June with a neutral position in fixed income. We had 45% portfolio exposure to equities and 5% in cash. And the move to de-risk the portfolio at that time followed the shift in the market sentiments to a bearish tone following that surprise US CPI reading in June of 9.1%. So a very hot reading, which triggered subsequent hawkish Fed action at the time. And being defensive in June helped the portfolios as we saw equities bottomed and bond yields rose. Then in July, we rotated some of our exposures within fixed income. We did that trade on July 5th, where we rotated some of our exposures within fixed income by selling 5% US government bonds while purchasing similar amounts of Canadian government bonds. And that trade resulted in us being overweight to Canadian bonds relative to the benchmark. And the rationale for that trade was prompted as we saw where Canadian 10-year government bond yields rose and the gap widened relative to US 10-year treasuries. So we saw that as an opportunity as we expected yields to converge, which would have resulted in the outperformance of Canadian bonds over its US counterparts. And when we look from a fundamental perspective, we expect Canadian growth prospects to weaken similar to that of the US, resulted in Canadian yields falling back in line with US. So that was a very good trade for us. Then also in July, we did another trade where we raised a bit more cash by selling 5% in equities. We sold 3% in SPY, 2% in EFI, which resulted in us having a 35% exposure to equities, 50% in fixed income, and a 10% allocation to cash. And if you remember the month of July, it was a particularly, it was a very interesting one where we saw a lot of risk on behavior. There was a risk on rally. And the risk on behavior that we saw in July was prompted for a few reasons. One of which was headline inflation seeming to have peaked. The second reason we saw where the market was repricing the possibility of a less hawkish Fed. And the third reason coming out of that risk-seeking behavior was, Q2 corporate earnings were better than expected. So in July, we saw where equities really outperformed bonds. Both asset classes did well in July, but equities really outperformed bonds during the month. And if we fast forward to August, the team sold 5% Canadian, it's 5% Canadian government exposure, bringing back Canada to neutral relative to benchmark. We also put some cash to work by increasing our US broad market exposure by 10%. At this point, we're currently benchmark neutral on equities and also on fixed income. And we have opted to be benchmark neutral at this time, given the level of market uncertainty, much of which is hinged on the path of inflation and central bank action. We don't expect equities and bonds to have a clear direction in the near term until the next round of key data releases, such as unemployment and September's CPI reading, which will then give us a greater sense of market direction. We're also keeping a very close eye on the economic surprise index. In the US, the economic surprise index has been edging higher since bottoming in June. If we get to a point where surprises begin to roll over, we could see recession fears being reignited and equities declining a leg lower. That being said, we're paying a very close eye on economic data so as to get a better sense as to market direction from here. So with that, thank you for tuning in. I'll stop here. Hope you found today's discussion very helpful. And with that, I say, stay safe. Thanks for watching. Have a good one. Bye.